You turn 40 and realize something uncomfortable. Most of your friends are talking about retirement. Some are discussing their investment portfolios. Others are talking about buying vacation homes. But you look at your bank account and wonder where all the years went. You spent decades working hard. You paid bills, you raised a family, you handled emergencies. You told yourself you would start investing later. And somehow, later became 40. For a moment, panic sets in. You think you missed your chance. You think investing is only for people who started in their 20s. You think you're already too late. Then one day, you come across a simple fact. The best time to start investing was years ago. The second best time is today. That sentence sticks in your mind. Instead of feeling sorry for yourself, you decide to take action. You open your laptop and begin learning. At first, everything feels confusing. Stocks, ETFs, index funds, dividends, compound interest. The financial world seems like a foreign language.
But you keep going. Every night after work, you spend 30 minutes learning. Little by little, things start making sense. You discover that investing isn't about getting rich overnight. It's about giving your money time to work. The next week, you open your first investment account. Your hands shake slightly as you transfer your first deposit. It's not a huge amount, just enough to get started. Part of you feels embarrassed. You wish you had started years ago. But another part of you feels proud, because for the first time, your money has a purpose beyond paying bills. A month later, you make another contribution. Then another. And another. You create a simple rule. No matter what happens, you will invest every month. At first, the account barely grows. The numbers move slowly. Sometimes the market goes down. You wonder if you're making a mistake. Then you remember why you started. You didn't begin investing to get rich next month. You started investing to build a better future. So you stay consistent. Months turn into years. Your habits become automatic. Every paycheck sends money into your investments. You stop checking the market every day. You stop worrying about short-term headlines. Instead, you focus on the long game. At 42, your portfolio reaches a milestone. Nothing life-changing, but enough to prove the system works. For the first time, you feel momentum. At 43, a market downturn arrives. News channels panic. People predict disaster. Coworkers talk about selling everything. Old fears return. You wonder if you should do the same. Then you remember all the lessons you've learned. Market drops are normal. Every major investor has experienced them. So instead of selling, you keep investing. Month after month. While others panic, you stay patient. The downturn eventually ends. The market recovers. Your investments recover too. And because you kept buying during the decline, your portfolio grows even faster when prices rise again. That experience changes you. You stop seeing market crashes as enemies. You start seeing them as opportunities. At 45, something unexpected happens. You check your account and realize your investments have earned more money than you imagined possible. Not because you picked the perfect stock, not because you got lucky, but because you stayed consistent. The power of compounding finally becomes visible. Your money starts generating returns. Those returns generate even more returns, and the cycle continues. You begin thinking differently about spending. Every unnecessary purchase has a hidden cost, not just the price today, but the future growth that money could have created. So you become more intentional. Not cheap, not obsessed, just intentional. At 47, your financial stress starts shrinking. You have savings, you have investments, you have a plan. For the first time in years, you feel in control. Friends who never invested begin asking questions. They notice your confidence. They notice your discipline. Many assume you discovered some secret, but there was never a secret. There was only consistency. At 50, you look back on the decision you made at 40. 10 years have passed. Your portfolio isn't worth millions, but it doesn't need to be. It represents freedom, options, security, peace of mind. Most importantly, it proves something important. Starting late is still better than never starting at all. You realize the biggest mistake wasn't beginning at 40. The biggest mistake would have been waiting until 50 or 60 or never starting at all. You smile as you review your account, not because of the numbers, but because of what they represent. Discipline, patience, growth, a future you once thought was impossible. And as you make your next monthly investment, you understand something many people never do. It's never about the age you start. It's about the decision to start. And that decision can change everything.